We're joined now for more analysis by Dr. Stephen Nash from FIIG Securities. What are you hearing about this offer? It's pretty rare, isn't it, for BHP? Normally it raises in US dollars?
Typically the company issues in foreign currencies, particularly the US dollar. I think this is signifying a little bit of a change in attitude towards the Australian dollar and demand for Australian dollar issues. I think the overall demand for Australian dollar investments is large, and this is, I think, changing the dynamics of the Australian bond market, where typically the local institutions would be the gatekeepers on issues, but going forward I think global institutions have such a demand for Australian dollars that these larger transactions by larger organisations can occur in the Australian market, which is leading to a deepening of the market and increasing the diversity, which is really a welcome development in the Australian bond market.
And I mean, for the Aussie dollar in particular there, I mean, because there has been some analysts thinking that it's going to go back to parity potentially in the near term. What do you think then that says about the outlook for the Aussie dollar then?
Look, I think the broadening and deepening of the bond market is a really positive development for the currency as a whole. The problem with the currency in some respects is the lack of diversity of bond opportunities. We've also had an announcement today of the AOFM looking to issue a new 2029 bond, which again indicates that the local authorities here are looking to lengthen our market, increasing the range of products that are open to investors, which again is another positive. I think the thing that's affecting the dollar right now is expectations of further cuts, which probably will get the Australian dollar more towards parity, but I think after those cuts are implemented, I think the overall yield pickup from the Australian dollar combined with the great credit story we have here will support our currency and lead it higher towards the 110 level.
Just looking at the BHP issue, we're hearing the pricing. Well, Dow Jones Newswire certainly thinks that the pricing is going to be 95 basis points over the underlying swap rate.
Yeah.
What do you think of that pricing? I mean, obviously they're going to confirm it later today, we're hearing.
That looks a little bit generous relative to the CDS, but I think that's the idea, is to get an issue away which performs well for local investors and global investors. I think that if that was to occur and we get that 95 level, the issue will be extremely well received. A lot of local institutions are looking for non-financial names. Obviously BHP's a very strong name, and I think the local take-up will be quite large, and it's great for the local investing community, I think.
Yeah, because there's no sort of thoughts on just how much they're going to raise from this. I mean, what would you sort of expect, or the demand might be?
Look, it could run into the $500 million level quite easily. It could be quite larger than that, depending on what orders come in from global institutions. I think it could be quite a large issue. Obviously, it's going to go in the major indices, and a lot of index-based investors will be purchasing this security as well. Again, I think the demand for non-financial names is quite large, so we should see a lot of demand here.
And do you think that we'll see a lot of other non-financial names then also, following BHP's move and launching Australian denominator?
We have seen a series of issues here from issuers that don't typically issue in Australian dollars, which I think again is just a sign of the basis swap is positive for a lot of these investors. That's one thing, but also I think the demand for Australian dollars is really broadening. I mean, the currency is one of the world's most traded currencies. It's very liquid. The lack of diversity in the Australian bond market is a negative, but that's starting to be reversed now, which is good.
Just wanted to ask you about what we've seen. I mean, we've had that ANZ jobs data out yesterday. Job ads started there, showing further weakness. What are your expectations then for this Thursday's read, the official read on the labour force?
Well, it's really a very important read for a few reasons. One is the RBA has highlighted that their assessment of the labour market is that it's starting to deteriorate somewhat. We have seen in the ANZ job ads data a surprising deterioration in job ads for the resource states. So the two-speed economy is rapidly becoming no speed and the idea that unemployment may start to spike is really something the bond market's very interested in. If it does occur, we could see quite a large rally in our bond market. At this stage, bonds are relatively inexpensive relative to the new cash rate. Expectations are for one more cut in November, so I think we need an impetus to get the market going, and I think the labour market report might be that.
Just wanted to ask you too, because we've seen the IMF and the World Bank come out and revise lower their forecasts. Well, particular focus, of course, on growth in the Asian region and what they're talking about with China revising lower their Chinese growth forecasts, and also the IMF lowering its forecast for Australian growth to be around 3%. So that pretty much in line with what the RBA had been saying. I mean, do these revisions, these cuts to forecasts, mean that much?
Well, typically these forecasts lag what private forecasters usually do, and I think to a large extent a lot of these revisions in growth have already occurred in terms of private forecasts. It's, I suppose, just an affirmation or a underscore of the growing weakness in the region with the World Bank cutting these forecasts. So I suppose it's a bit of a lagging indicator, but I suppose it validates recent cuts to growth by private forecasters, and I really don't think it's that much of new news. The question is what happens going forward, and the capacity of the Chinese to stimulate their economy. It remains an open question. There are a lot of avenues open to the Chinese, including extra infrastructure spending, so we have to see what the authorities will be doing going forward. But the market's expecting the Chinese to stimulate more and hopefully lift growth in 2013.
Just wanted to ask you too about what you're watching the oil price quite closely. We've seen Michael McCarthy from CMC Markets was chatting to us about this a little earlier, and you know, he thinks that perhaps, you know, the re-election of Hugo Chavez in Venezuela I mean, that this could actually support the oil price. What other moves are you watching around the globe that you think could push the oil price higher?
We've got a lot of conflict in the Middle East right now. We've got, particularly the Syrian situation is a little bit of a tinderbox. It's been going on for quite a while now. We've had the Turkish incursion, which is quite a serious development. Also the realisation that Iraq is supplying oil to Syria, which the US are quite concerned about. The US has also indicated that it opposes any developments in terms of nuclear capacity in Iran. All these developments are going on in the background, and I think are quite supportive of a higher oil price at some point. The market at the moment is not really focusing on these, but I think at some point that's probably the development people need to focus on, with a significantly higher oil price as a result of escalated tensions in the Middle East.
Just quickly on Europe too, because we've seen a lot of headlines coming out from European officials talking about, you know, they're confident in Greece, they're confident Spain's not going to need this any bailout just yet. You know, now that the ESM is operational, but they're saying they don't need to use it just yet. What do you think? I mean, will markets again take this as a sign of encouragement and stability in the Eurozone region?
Look, I think the authorities have done very well by manipulating expectations, but there comes a point where I think we've got to get some, where the rubber meets the road, where action actually occurs. I think the market's growing a little bit impatient with continued discussion of whether or not Spain will ask for the bailout. I think basically the market's growing a little bit impatient. At some point the markets will start to push those 10-year Spanish yields higher, and I think at that point the Spanish authorities will request the bailout that the market expects them to take, and I think that would be quite a positive for markets going forward.
Great to get your thoughts as always. Lots going on, isn't there? Thanks so much.
Okay.
Dr. Stephen Nash there from FIIG Securities.
Todd joins us this morning from FIIG Securities. Mark, great to have you on board. This has kind of developed through the morning in terms of the amount of detail that we've got. Where are we at right now in terms of the exact information on this offering?
The way this works, Brooke, is that they do a roadshow. First they do a conference call, they talk to clients. They will take this offshore tonight. BHP's Treasury's in London, so they've got great support. You know, it's a $175 billion market cap, so they have great support everywhere, clearly. But they will go back into the European night. They will talk to clients about the Australian dollar assets they might want to buy, and a lot of clients who are offshore investors will want Australian dollar assets just as a natural hedge because of what you've been talking about in terms of the currency and its underlying performance. They'll then reconfigure and come back with a further settlement on what they expect to get. So the analysis, we think it'll be a little bit better, a little bit sharper than what you're suggesting, around that 82 to 88 range over the swap curve, over the underlying credit. So the government bond curve, they'll look at that and they'll pay probably 85 points over that. We imagine that's what it'll be.
So at that price, how do you think that would be received?
Well, I think BHP, to be honest, they're able to generate funding at a sharper levels than the actual banks. The banks are, there is a bond around that maturity in the NAB 17s. That bond trades at about 107. So if you can get something in below 90 and the banks are at 107, this is, it's clearly something the banks wouldn't want to see. They're only making fees on the way they generate the issue. But the old days of being able to borrow money and lend to a corporate seem to be in some transition.
So just clarify, what would the banks think of that? Just broaden out that point, because that seems quite important.
Well, we've seen with a few of the industrials at issue, whether it be a Wesfarmers, whether it be a BHP, any of these easily recognisable brands are able to get some great funding levels from institutional investors, and the basis of that is banks come into the market and issue so many financial bonds that if you were an investor, you'd like to have a natural hedge. You want to have some diversity, so you buy the four majors, you might buy some regionals, but here's an A-rated piece of paper from a corporate that gives you some hedge against your natural book, your natural bias, because you're always buying bank paper. So you'll look at Wesfarmers, you'll look at BHP, and you'll pay at a premium to what you'd expect the rates to be, 3 weeks ago.
There was, I understand on the phone hookup that you just mentioned by BHP, that BHP said it's committed to a strong A rating, quote unquote, and they clarified that to be either A plus or A. Now it's currently on A, so it seems to be allowing for a slight, a notch downgrade basically in that.
Yeah, and I wouldn't see that as being anything significant. Okay. I think the fact that BHP is out there saying we will have high quality rated paper, the reason for that is if you look at certain funds, they can only invest in a minimum A grade. So you'll be going to those funds and saying we will make sure that the paper that you buy now doesn't get regraded so that you'll then have to sell it. You can only hold a certain quality of paper. So it's just BHP giving some affirmation to the market of where they intend to manage their business and manage the paper that they issue from their business. And that goes back to the point where they'll look to make some job retrenchments, they'll look to migrate away from the dependency on certain China recovery stories.
And the continued efforts towards cost cutting seem to be part of that pitch that they were using today, I guess of interest to equity investors as well.
Yeah, I think that's a business model that a lot of people are looking at. They looked at BHP and the Olympic Dam response, and some of them judged them harshly about the lack of planning around Olympic Dam. It was on board and then quite quickly it became off, and it was such a big project. So BHP will look to say, as managers of the business, we're quite efficient. We are looking at trends that will have an immediate response. We won't have massive lag responses to these trends. So if you're an equity investor in BHP, you'd have to make a decision on whether that's good or bad. At a macro level, it makes sense to manage your business. From here in the bond market, BHP is a top quality credit. You'd imagine a lot of institutional investors would want to buy that paper. Yeah,
and you've mentioned the attractiveness for investors, basically with the ability to diversify their own portfolios, to take up this offer, for example. But for BHP as well, there's an important point about diversifying, because usually the core funding markets are in euros and in US dollars. So what's the significance of this one being in Australian dollars?
Such a, the Aussie is such a commodity currency. It's traded so actively across the curve now. It makes sense to be able to say that we'll offer you paper in something you will naturally be trading anyway. So if I'm a fund that's in Europe and I want to trade Aussie, what do I buy? Do I buy a government bond at 3%, or do I look to buy BHP at a spread of 80 or 90 or whatever it will turn out to be? As a trader, it makes sense. I take some government credit and I take some Australian credit, some corporate credits, and that will then overlay that with some banking credits. It becomes quite a nice portfolio.
And what's the significance, or what does it signify about the broader story of the Australian dollar bond market, or the Australian bond market?
Oh, I think the Australian bond market's in good health. I think the fact that somebody like BHP will come and issue in the Aussie, where historically people have been saying that they issue in euro and dollars, just points to the sign that there's a lot of money in Australia. It's a very strong economy naturally compared to the rest of the Western economies. And so as a consequence, because there's such a high level of savings here in Australia through the superannuant business, you might as well tap into that business and try and issue some paper that people want. At the moment, everyone wants fixed income. That's the reality of life as we go through that structural change. What's happening with that structural change is people either buy direct bonds as they do here, or they put money into bond funds. So they'll put money into an Aberdeen or a Schroders, and Aberdeen and Schroders need to be able to find assets. So they would say, we've got a lot of money, who would like to issue to us? And BHP would probably fit that parameter.
So it is a story about that. Well, it's about what that. Yeah, it's a couple of things, isn't it? It's about the attractiveness of Australia compared with a lot of other markets at the moment, and that move towards fixed income. Despite the fact that we're seeing it, it's improved sentiment, across equity markets as well, which is pretty interesting.
There is improved
Well, you've still
sentiment.
got that interest though in fixed income, even though equity markets look like they could just take off.
Yeah, that's right. I mean, I think they're reluctant buyers. I spoke about it this morning. I think the idea that you will now get into a market and buy a penny dreadful and make it from 10 cents into 20 cents is gone. That's irrelevant. It's just not going to happen. So what's happening in the market, in the equity market in particular, is the demand for yield. People are looking for conservative assets like a Telstra or a CBA or a Westpac, and they're looking for the yield they're getting, and they're driving that market forward. But in terms of the rest of the equity market itself, it's been dragged along kicking and screaming with some outliers. But the truth of the matter is, the investor base is saying, I want some certainty in performance, and the equity market isn't necessarily going to give you that. It's only been stimulated by QE3 and what becomes next. So the idea of clients looking to try and trade the equity market in the way they did previously a decade ago is pretty much over. And they will be looking to either changing their term deposit performance so they'll get fixed income with higher yields, or they'll look for some equity performance that give them consistency in earnings as opposed to consistency in performance. It's a big difference. If I buy Telstra at $3.80, $3.90, whatever it's going to be, I'm not expecting that to go to $5, but I expect them to pay 14 cents every half. And that's what I need to look at. And that pays for the retirement I want, or the expectations that I want as a trader. That's what they're looking for at the moment.
Mark, Todd, thank you so much. You've explained that very well to us. We appreciate that this morning. Thank you.
Sure, Brooke. Have fun.
Thank you. So that's Mark Todd from FIIG Securities on that Australian offer.